Warren Buffett. His name is synonymous with wealth. He's the grandpa everybody loves that knows more about investing than we do. But surprisingly enough, Warren Buffett has been very open about how he's earned his wealth. The CEO of Berkshire Hathaway is here to teach us how to make millions with just a little money, and even more impressive, all you need is just 3 stocks to reach Lamborghini status. I mean, who needs a degree in finance when you have Warren Buffett telling you what to do, right? According to him, the secret to his success lies in value investing, which involves finding stocks that are undervalued by the market and investing in them for the long haul. And he's not talking about a few months or a year. We're talking about years, even decades of waiting and watching those stocks grow. While most people want to get rich today, those who are patient are rewarded handsomely more than those who don't. Along with having patience, you also have to have persistence and the ability to resist the temptation to jump ship when the stock market takes a dip. Kind of like right now when the recession signals are flashing red before our very eyes. However, some people continue to think that this time is different and a new bull market is coming. So grab your calculators and get ready to take some notes, because Warren Buffett is about to show us how to make millions one undervalued stock at a time. Let's focus on Buffett's investment philosophy, which involves buying and holding stocks for years, even decades, rather than trying to time the market or make quick profits. His strategy is rooted in his belief in the power of compounding. He understands that the longer he holds on to a stock of a high-quality company, the more time it has to grow and generate returns. To find this type of company, as mentioned earlier, Buffett employs a value investing approach and looks for companies that are trading at a lower price than their intrinsic value, as determined by their financials, assets, and earning potential. In simpler terms, by buying these stocks when they're undervalued, he's able to maximize returns when the market eventually corrects and the companies reach their true potential as he predicted, leading to rising stock prices. Isn't it just amazing how he has this knack for investing in struggling companies and turning them into gold mines? It's not like he's just throwing darts at a board blindfolded and hoping for the best. Instead, he actually takes the time to understand the companies, their potential, and their risks, and then makes decisions grounded by extensive analysis while avoiding the temptation of jumping from one hot stock to another. But buying these kinds of stocks is only part of the equation. Buffett is also very selective when it comes to diversification. While many investors choose to spread their money across a wide range of stocks and industries to reduce risk, Buffett believes in holding a concentrated portfolio of stocks. In his view, diversification can actually dilute returns and lead to mediocre performance. Instead, he prefers to focus his investments on a handful of companies that he believes in and trusts.
There's nothing magic. We like to put a lot of money in things that we feel strongly about. And that gets back to the diversification question. We think diversification is, as practiced generally, makes very little sense for anyone that knows what they're doing. Diversification is a protection against ignorance. I mean, if you want to make sure that nothing bad happens to you relative to the market, you own everything. There's nothing wrong with that. I mean, that is a perfectly sound approach for somebody who does not feel they know how to analyze businesses. If you know how to analyze businesses and value businesses, it's crazy to own 50 stocks or 40 stocks or 30 stocks probably, because there aren't that many wonderful businesses are understandable to a single human being in all likelihood. And to have some super wonderful business and then put money in number 30 or 35 on your list of attractiveness and forego putting more money into number 1 just strikes Charlie and me as madness. You know, if all you have to achieve is average, it may preserve your job, but it's a confession in our view that you don't really understand the businesses that you own. On a personal portfolio basis, you know, I own 1 stock, you know, but it's a business I know, and it leaves me very comfortable. Do I need to own 28 stocks in order to, have proper diversification? It'd be nonsense. And within Berkshire, I could pick out 3 of our businesses, and I would be very happy if they were the only businesses we owned and I had all my money in Berkshire. Now, I love it, the fact that we can find more than that and that we keep adding to it. But 3 wonderful businesses is more than you need in this life to do very well. And the average person isn't going to run into that. I mean, if you look at how the fortunes were built in this country, they weren't built out of a portfolio of 50 companies. They were built by someone who identified with with a wonderful business. Coca-Cola is a great example. A lot of fortunes have been built on that. And there aren't 50 Coca-Colas. There aren't 20. If there were, it'd be fine. We could all go out and diversify like crazy among that group and get results that would be equal to owning the really wonderful one. But you're not going to find it. And the truth is you don't need it. A really wonderful business is very well protected against the vicissitudes of the economy over time and the competition. I mean, we're talking about businesses that are resistant to effective competition. And 3 of those will be better than 100 average businesses. And they'll be safer, incidentally. I mean, there is less risk in owning 3 easy-to-identify wonderful businesses than there is in owning 50 well-known big businesses. And it's amazing what has been taught over the years in finance classes about that. But I can assure you that if I had to bet the next 30 years on the fortunes of my family that would be dependent upon the income from a given group of businesses, I would rather pick 3 businesses from those we own than own a diversified group of 50.
What he's saying is that much of what is taught in modern corporate finance courses is twaddle.
Of course, this approach also comes with risks. If one of the stocks in his portfolio experiences a significant decline, it can have a major impact on his overall returns. But for Buffett, the potential rewards of a concentrated portfolio outweigh the risks. He also recommends that most investors who do not want to commit to finding and analyzing a stock just stick with low-cost index funds that track the S&P 500, because that too will have average returns and they are reliable. 7% on a yearly basis is pretty darn good. Just ask the crypto bros who seen prices drop over 50% since their all-time highs not too long ago. Now let's find out how Buffett harnessed his investment strategy to these 3 stocks that made him millions and how he benefited from them so much, namely American Express, Coca-Cola, and Wells Fargo. In the 1960s, Amex faced a crisis due to the salad oil scandal, and because of this, the entire futures and commodities markets were nearly wiped out. Amex's stock price plummeted, and many investors panicked. However, unlike the others who shied away from Amex, Buffett saw this as an opportunity to invest in a great company at a low price. With its solid competitive advantage and a loyal customer base, Buffett temporarily ignored the scandal and trusted his gut. And his gut is worth more money than you can comprehend. He bought a total of $1.3 billion worth of its stock, stopped in 1995, and held on to that since then. Buffett's investment in Amex has grown to over $22.4 billion, which is a 17 times gain with an estimated dividend rate of 23%. This is the power of his value investing approach. Proven effective in Amex, he applied this to his other investment decisions from then on. Patience is truly a virtue. The next is Coca-Cola. Buffett invested in Coke in 1988 when it was not as popular as it is today and was still trying to recover from the Black Monday crash with severely devalued shares. Buffett saw the potential in the brand and invested a total of $1.3 billion in the company to get 6.2% ownership by 1994. Today, Coca-Cola is one of the most recognized brands in the world, which again proves Buffett's keen eye for potential, and his investment has eventually paid off. In fact, it is estimated that his stake in Coca-Cola, now at 9%, has grown to a whopping $24 billion, not mentioning yet the dividends he earned over the years, which is around $10.2 billion or 54% annual rate. Up next is Wells Fargo. Enticed by the fact that it has a cheap price but is still a well-managed bank with so much potential, he began investing in the company in 1989, and his initial investment was $290 million for a 9.7% stake, which grew up to 13.3% until 1994 because of continuous investments during the housing crisis. Wells Fargo is one of the largest banks in the world, and Buffett's investment in the company has been highly profitable through dividends and continuous increases in stock prices. It is evident since his share in the company peaked at $12.7 billion in 2016, with a market value of $22.1 billion in that same year. Although slowly over the years he dumped a significant number of stocks, and because of corporate issues, controversies, and the lost moral compass of the company, Buffett cut ties with Wells Fargo in early 2022